Hi, welcome back to another video. Investing in index funds and ETFs is one of the best ways to manage market volatility, market risk. And that's because index funds and ETFs, exchange-traded funds, are a kind of mutual fund, a bundle of stocks. So they are diversified by design. The broader or the more diversified an ETF is, the better quality it is. Especially if, as an investor, you are investing for the long term and you're not just chasing yields, because there are a lot of smaller ETFs or index funds with a few stocks, like 20 maybe, and they have high yields. I'm not pursuing those kinds of stocks. So most of my ETFs have at least 100 stocks in them, but that's just my choice. Now, when you research ETFs, there are certain stats you should look at. Things like the expense ratio of an ETF. You should also look at the composition, the kind of sectors in it, or the number of stocks, or the type of stocks that dominate a specific ETF. And you probably want to look at the return of the ETF. So with that being said, let's look at my ETFs. I have 5 ETFs in total in my portfolio. The first is SPLG. SPLG is a State Street SPDR S&P 500 ETF. It tracks the S&P 500, which is an index made up of 500 of the largest companies in the US. The issuers of SPLG, State Street, is the same company that issued the first S&P 500, the popular SPY ETF. So that is State Street. SPLG is a low-cost ETF. In fact, it is the least expensive ETF among all my 5. It currently has an expense ratio of 0.02%, meaning that it would cost me about 20 cents for every $1,000 I invest in SPLG. It currently has a yield of 1.38, which is a decent yield for an S&P 500 ETF, because the S&P 500 is dominated by technology companies, and generally we know tech companies barely pay any dividends. Now, the ETF is made up of 503 stocks. Now, somebody would expect that because it tracks the S&P 500, it would be made up of 500 holdings. That's not the case, because some companies have 2 classes of stocks. Google, for instance, has Class A and Class C stocks. So those are counted as 2 individual ones. So anyway, SPLG is made up of 503 stocks, just like other ETFs that track the S&P 500. SPLG is issued by State Street, as I indicated, and here is the weighting of the ETF. The top 5 sectors in this ETF include technology, financial services, healthcare, consumer discretionary, and communication services. Round up the top 5 sectors in this ETF. And the top 10 holdings or companies include Apple, Microsoft, Nvidia, Amazon, Meta, Berkshire Hathaway, Alphabet, Class A, Broadcom, Alphabet Class C, and Tesla. You'll notice that only Berkshire Hathaway is a non-technology company. This is a financial services company, I believe. Now, let's look at the returns for SPLG on the ETF Research Center. So SPLG, research that. The ETF has nearly $70 billion in total assets, or assets under management, SPLG. This is the sector distribution on the ETF Research Center. Let's look at the performance. So you can see the chart. It's upward trending. It's a true reflection of the S&P 500. And in terms of absolute numbers, total returns, year to date, it's returned about 1%. And over the last year, it returned 13.3%. And over the last 5 years, it returned nearly 16%. And since inception, it's returned 10.5%, just over 10%. And so that's a solid return right there. Now, if you've watched some of my prior videos, you'll know that I invest on Questrade. At least the portfolio I share with you all on this channel is on Questrade. And until early this year, Questrade did not offer fractional shares. And so in order for me to start investing in the S&P 500, I had to start with an S&P 500 ETF that was affordable so that I could buy a whole stock, because I could not buy a fraction. Of all the quality S&P 500 ETFs that I was considering, VOO, IVV, SPY, SPLG, and others, SPLG was the most affordable. So I started the SPLG position late last year because it was the most affordable among the different S&P 500 ETFs that I was considering. That being said, the performance of SPLG, VOO, IVV, SPY is all very similar. The difference between SPLG and the other bigger S&P 500 ETFs is that assets under management are a little lower with SPLG at about 70 billion compared to hundreds of billions in some of the other S&P 500 ETFs. Now, I currently have just 98 shares of SPLG, and the total cost invested in the position will be listed down in the description section. I will provide the total amount invested in each of the ETF positions in the description section below. The second ETF in my portfolio is VTI. VTI is Vanguard's total stock market ETF, and it tracks the entire US stock market, every publicly listed stock or company in the US. At the time of this recording, the share price is $293. It has a really low expense ratio of 0.03%. It would cost me 30 cents. It would cost an investor 30 cents for every $1,000 you invest in this ETF. So the advantage of investing in a broad market ETF like VTI, which covers the entire US market, is that you have access to large cap stocks, mid cap stocks, and small cap stocks. And each of them has its own advantage. Large cap stocks are great for dividends, but also for growth. Because, for instance, currently the US economy is dominated, the US markets are dominated by tech companies, and those are great growth stocks. But they also have large classic, the old classic companies like Procter & Gamble, Johnson & Johnson, Coca-Cola, and so on, good dividend payers. Mid-cap stocks and small-cap stocks are great for growth. While you're enjoying the advantage of the mature larger companies, you also get to enjoy the benefit of the mid-cap stocks and small-cap stocks as they progress and grow and become bigger and more moneyed companies. It currently has a return of about 1.6%. Year to date, it's only returned less than half a percentage point, but look at the 1 year return of the stock, about 13%. 5 years is over 15%. And since inception, VTI has returned nearly 9%. That's a solid return right there. Portfolio composition. VTI is made up of more than 3,500 stocks, as you can see here. That is as diversified as they come. And total assets under management, more than $1.8 trillion. The top 10 holdings of VTI include companies like Microsoft, Nvidia, Apple, Amazon, Meta, Broadcom, Google Class A, Tesla, Berkshire Hathaway, again, Alphabet Class C. You'll notice that among the top 10, the only non-tech company is Berkshire Hathaway. So dominated by the tech sector, that's why it's not a big dividend payer. So in terms of expense ratios, again, it's really inexpensive at 0.03%. And usually this is built into the price, so you're not going to see 30 cents coming off your account or something like that. Now, long term, I'm hoping to build this ETF into the foundational ETF in my portfolio. But currently, I only have 21 shares of VTI. I started this position last year. The stock is a bit expensive now at about $300 a piece, but I will build it up to be the dominant ETF in my portfolio long term. So the race is on. Now, if you enjoy content like this, please consider liking this video and subscribing to my channel. It helps the channel grow. It also encourages me to keep making these videos. Don't forget to share with family and friends and hit on the bell icon so that you're notified every time I post a new video. So the third ETF in my portfolio is XIC, another total stock market ETF. XIC is a broad market ETF by BlackRock, and it tracks the entire Canadian stock market. It contains every publicly listed company on the TSX, the Toronto Stock Exchange. At the time of this recording, the share price is $42.48, and year to date, it has returned nearly 9%, 8.53. That's a solid return right there. 1 year return, the last year's return, over 20%. The last 5 years, it's returned nearly 15%. And since inception, it's returned nearly 8%. that's a sound return right there. Now, I hold XIC for more than one reason. One is so that I own a piece of every publicly listed company in Canada, of course. The other reason is that because XIC tracks the entire Canadian market, and the Canadian market is dominated by great dividend payers, companies in the energy sector, financial services sector, utilities. I hold XIC more as a dividend payer than for anything else. But also, the Canadian economy continues to grow and perform very well, as we just saw from the returns of this ETF, 20% over the last year, 15% over the last 5 years. That's material growth. XIC is a great ETF. So assets or assets under management, the ETF currently has nearly $17 billion. That's Canadian. It's listed on the Toronto Stock Exchange, the TSX, and it has 214 companies or stocks rolled up or bundled up into this ETF. It has a good yield of nearly 2.5% TTM, trailing 12 months. So that's basically an average of the last 12 months, the yield over the last 12 months. And it has a nice price to earnings ratio. It's also eligible to be invested in for the different tax sheltered plans like the RRSP, the TFSA, the Fast Home Savings Account, and so on. Let's see its composition, holdings. Again, because it tracks the entire Canadian market, it will be dominated by the top companies in the Canadian economy: Royal Bank of Canada, Shopify, TD Bank, Enbridge, Brookfield, Bank of Montreal, Canadian Pacific, Kansas City, Canadian Natural Resources, Constellation Software, and Bank of Nova Scotia. So XIC has a low expense ratio of 0.06%. I currently have just 65 shares of XIC, just one of those positions I started in 2024, but I'm looking to build this into a more dominant position in my portfolio. The fourth ETF in my portfolio is SCHD, a popular Schwab dividend ETF among investors. Obviously, as a passionate dividend investor, it should come as no surprise that I hold SCHD in my portfolio because I am building this portfolio so that it will ultimately replace my employment income and allow me to get financial freedom. The ETF has a low payout ratio of 0.06%, so about 60 cents for every $1,000 you invest in it. The stock had a stock split in October of 2024, late last year. Prior to the stock split, it was trading at about $85. It's currently trading at about $27 per share. Fund profile. SCHD has total assets of about $70 billion. Total holdings in SCHD, 103 stocks in it, a little lower. TTM yield is nearly 4%. Now, SCHD is not just a popular ETF, it offers a really nice yield. In fact, its last dividend in March of 2025 was 20% higher compared to March of 2024. Unfortunately, the ETF is down nearly 5% this year, but if you factor in the 4% yield, then you're down just minus 1% year to date. Now, let's look at the return, annualized return. You can see here that over the last month, it's starting to recover. It's up about 1.3%. Over the last year, it only returned 3.78. Over the last 5 years, it returned about 12%. And since inception, it's returned over 12%. A solid return, if you ask me. In terms of top holdings, the top 10 companies in SCHD include ConocoPhillips, Cisco Systems, Texas Instruments, Altria Group, Chevron, Lockheed Martin, Coca-Cola, Verizon, Amgen, and Home Depot. You will notice here that no single company represents more than 5% of the ETF, and that's a well-balanced distribution among individual companies in the ETF. And in terms of sector distribution, the top 5 sectors are energy with 21%, consumer staples, healthcare, industrials, and financial services round up the top 5 sectors in SCHD. I have a small position here as well. I currently have 133 shares only, and so I will be looking to invest aggressively in VTI, SCHD in the coming months. So last but not least is another Schwab ETF, SCHG. This is a large cap growth ETF and it has an expense ratio of 0.40. Again, really inexpensive. You can see here that SCHG also had a stock split in October of 2024, and that's the time when I started investing in SCHG. Prior to the stock split, the stock was trading at over $100, about $103. It's currently trading at about $28 per share. It has net assets of about $42 billion currently. Total holdings in SCHG, number of stocks, 231. Let's have a look at the portfolio distribution before we go look at the returns. So the top holdings, as I indicated, it's dominated by tech companies, Microsoft, Nvidia, Apple, Amazon, Meta, Broadcom, Tesla, Alphabet Class A and Alphabet Class A and Alphabet Class C, and Eli Lilly. Eli Lilly is the only company among the top 10 that's not a tech company. Eli Lilly is healthcare. Something else I failed to mention, yields. See how immaterial, how small the yield is, less than 0.5%, just because largely technology companies hardly ever pay any dividends. So you do not invest in SCHG for dividends, you invest in it for growth. The returns, you can see clearly, even for the last month, it's returned about 8%, but look at a whole year's return. 17%, the last 3 years over 20%, the last 5 years about 18%, and since inception over 16%. That's an impressive return, over 16%. So I currently only have 40 shares of SCHG. As I indicated earlier, I started this position largely to allow me invest in a growth ETF, but Questrade did not allow for fractional shares, so I needed to find and invest in a quality ETF that was inexpensive, that was not super expensive, so that every time I got dividends, I could buy a whole share. Once SCHG had a stock split, it became very affordable. But that is my position in SCHG, only 40 shares at this point. Now, a question of overlap is going to come up regarding my ETFs. I have 5 and all of them seem to be broad market ETFs. I do have overlap between some of my ETFs, but based on my financial plan and my timeline, I feel justified to have overlap. I hold these stocks generally in different accounts. So for clarification, I have 3 different accounts in this portfolio. And because I am investing for retirement, for early retirement, I am looking to tap into the different accounts at different times. Anyway, I hope you enjoyed the video and found it helpful. If you did, please consider liking and subscribing, share with family and friends. I'll see you in the next one.